Hello, everybody, and welcome back to my channel. I was thinking on what content to provide you all, and I was thinking of maybe I can talk about mechanical entries and I can talk about how simple this trading strategy is. And while I was putting together my thoughts, I came across this post, and I will read that post to you in a minute. But if you've ever been frustrated with multi-time frame analysis, if you've ever suffered from paralysis with analysis, where your daily is telling you one thing, your 4 hours telling you another thing, your 1 hour is telling you another direction, your 15-minute hasn't made its mind yet, and you were just waiting for that perfect alignment of stars, right, where every time frame is in the right direction with the right setup, and in waiting and in doing so, you just suddenly realize that weeks have passed and there has not been a perfect setup yet. And what happens then is that you get desperate, you get involved in less than optimal trades, building a narrative to fit your bias, you lose. Obviously, when you lose, you become more desperate, you get into revenge trading, and before you know it, you've failed your prop firm challenge, you've blown your account, and you just spiral down into desperation and help in this trading world. Now, the post that I read that I talked about earlier, I'm going to read this and then I will share what this video is going to be about. So the guy writes, I feel frustrated. Every day I wake up in the morning to analyze the market. I mark my points of interest and I end up sitting 4 to 5 hours in front of the chart without being able to reach a clear conclusion, especially when trying to align all the time frames. The 4 hour shows me one thing, the 15-minute is in premium. I find myself constantly analyzing but never executing. And every time it feels like price just runs away from me. I see a break of structure and I think to myself, okay, here's my opportunity, but then price just goes the other way. I don't really appreciate any tips or advice on how can I improve. Now, when I read this, I felt the raw emotion and a desperate cry for help. And I know, believe you me, I've been there myself, and it just takes time, right? A time and then a strategy that makes sense. It's simple, it's repeatable. You can do it yourself. It's a skill set that will stay with you forever, right? And this is what I'm going to show you today. So instead of cherry picking trades to show you all on what a winner looks like or what a loser or break even looks like, what you see on your screens right now is my live GU chart. These are the exact markings that I've put together when I'm looking at the market live. And obviously I trade London and New York, but I also went in marking again to rebuild within myself, to reinforce or re-emphasize that this works, right? Obviously, everybody, including myself, are susceptible to having doubts. Doing this for so long, those things come into your mind, creep into your mind, where you start self-doubting yourself and self-doubting the strategy. So I keep marking every opportunity, and then obviously I execute when the time frame or the timings are optimal. So what you see right now is the exact markings that I put while the market is in action, and I'll walk you down through each and every one of these opportunities and see how we ended up with the day. Okay, so let's go. Typically what I do is I have a daily chart open as well. And what I do in the daily is very, very quickly, very simple. I just put a vertical line on the day that I want to trade in. This was yesterday, today is the 21st. On my charts, these markings that you see was on the 20th. And then I will just put a vertical line that this is the day, start of the day, and this is what I'm trading. Next I will do is I'll just put a gain box with 100%, 0%, and 50% on the range of the previous day's candle. The only reason, I'm not looking at any bias right now, the only reason I'm doing this, it gives me parameters on where I am compared to previous day's range. And that is just premium and discount. So if I'm in premium, I'm looking for sell opportunities more than buying opportunities. But again, if a trade comes in and the setup is great and it is a mechanical entry that I trade often, I will take it. So it's not that I'm only looking for sells and just ignore buys. And if it is in the discount range, I'm looking for buys. And again, I'm not going to discount the sells, because if the trend is downwards and an opportunity presents itself and it's a mechanical entry model that I trade, I will take that trade, knowing full well there is a higher opportunity that I might lose, but I'm willing to take that risk because I've proven to myself over hundreds and hundreds of trades that these type of setups can work, and I know what type of risk I'm getting involved in. Obviously, buying in the discount would be much favorable. Okay, so once I've done this, I close my chart into two, and this is exactly what I'm looking at. So let's start off when I came to the charts. That was about 9:45 Dubai time. We still have being in Dubai, the market London opens at 11 a.m. Currently, so a couple of hours before that, I start looking, just analyzing what the charts are showing, because there have been extremely good opportunities pre-London, Frankfurt Open, pre-London as well. And then when London kicks in, you get all this momentum coming in, and that is prime trading opportunities you will get. Typically, I don't trade the lull because markets are just dying. Some days you will get beautiful trends. Some days you will get ranges. I try to stay away from this. Obviously, if you want to repeat this for the next 10, 20 years, you don't want to be glued to the charts for full day, right? You're doing this as an escape so you can work a couple of hours with full focus and then spend the rest of your time with your family, with your loved ones, or whatever it is that you love to do. And then New York opens, another beautiful momentum coming in, and then the various trading opportunities there. So as I walked in, the first trade, and let me go to the first trade, and I will walk you through every one of these trades, and we'll keep marking or keeping a tally of how many R's we made, how many break-evens we did, how many losses there were, and then we'll just sum up all the opportunities for the day. And I will also explain why I entered into those trades. The first one here. Typically what happens here was that there was a giant wick and the price closed above the previous candle's close, all right? So it closed here, it opened, it had a giant wick, and then price closed bullish. So even though it was not my ideal setup, the previous candle was bullish, that 115-minute candle. What this 115-minute candle tells me is the price is trending upwards on the 1-minute chart, right? So if the 1-minute chart is trending upwards, I'm anticipating that this candle right here, where I have my crosshairs, look at the vertical lines, this is going to be bullish. And if I get an opportunity to catch the wick of the next candle, then I'm getting involved. So what I typically do is I will create this box around the previous candle, the 15 minutes that I'm trading in, and just stop at the start of the next candle. This box right here, this light red box right here, right? What this allows me to do is that once I've drawn this, I am strictly and only focusing what happens, what is price delivering to me within this box. I am not interested anywhere else outside the chart, what is going on. I'm just laser focused. Where is the liquidity? Where is inducement? What type of mechanical entry model that I'm getting at? And if that develops, then I'm getting involved. In this case, what happened was, this is the box of the candle that I want to trade, and the previous 15-minute candle. This is the halfway mark, the start of the new candle. And what I saw was that price was trending downwards. This was the last lower high, lower low, and then this high was broken. So the price has obviously turned bullish. Then price started to retrace back. This is the wick creation. And while it was pulling back, it also swept some liquidity over here. Why do I call this liquidity? Because this low broke the fractal high over here. And once this gets taken, I'm waiting for a reaction to happen from a nice little demand zone. Now, if there is a solid reaction, such in this case, I place a stop order entry at the close of this candle. So as soon as the next candle opens up, I'm in the trade. And depending on how you guys want to manage this, either you break even quickly, or you have a -1 loss, or you reach a target. In this case, there are different methods that I use for my trade management, depending on how the trade is set up, the hours the trade is coming in, what type of momentum and what type of pattern is developed within that 30-minute window, the previous 15-minute candle and the 15-minute that I'm trading in, and I will manage my trade aggressively. So in this case, let's say we have a break even, and I am going to put over here a break even, right? Break even, why? Because at 1 hour I break even for the purposes of this day, for all the trades today. And if it reaches 2 hour, that'll be my target. But obviously I will show you the potential that it could reach many more hours. So let's move on. Then what happens is that we have, so this is the trade that you see here, 1.93 hour. This is right here, okay? So then what do I notice? I notice that we have a nice sweep of the high of the previous candle, and then we have a strong bullish close. Now, ideally, what I would have loved about this is that if it closed below this wick, that means it has broken a swing structure point on the 1 minute chart, but it has only broken the internal structure, right? So if I'm looking at the delivery of price, lower high, lower low, higher high, higher low, higher high, higher low, higher high, and then this was the low that was responsible for this high, and then it gets taken down with this beautiful downtrend, and that is this black bearish candle right here. So once that trend develops, what is it that I'm doing? I'm waiting for a pullback to happen into a nice little supply, and I'm waiting for some level of inducement taken, and then I'm waiting for a reaction. So in this case, I already see that there was inducement taken. So this was inducement or liquidity, however you want to call it. Let's say 1 minute liquidity was taken here. I would also argue with you that there was another liquidity, set of liquidity taken over here, because it swept high and then it closed. And let's call that 1 minute liquidity as well. And then we had a strong reaction. It's a perfect setup, right? You have inducement and you are reacting from a nice supply zone. You have a solid reaction where you clearly see there is an OFC, order flow change, and then we have a nice big bearish close. I place an entry, a stop order at the sell stop order at the close of this candle, with anticipation that the next candle will continue bearish following the momentum of this candle. 9 out of 10 times this would have worked out, but nothing is 100% in life. So this one, unfortunately for me, was a loss. It did not reach the 1 hour that I was expecting to break even my trade, but yeah, -1. So let's capture this as -1. Okay, let's move on. So this was the trade that we just talked about, and then guess what happens? A beautiful momentum candle happened exactly at London Open, 11 a.m. Dubai time, right? How beautiful is this candle? It swept the low. It opened up here, swept the low, created all this bullish pressure coming in, swept the high, and then closed pretty heavily bullish. So it did not come down 50% of the way. It did not come down 3/4 of the way. It closed strong bullish with nice healthy wicks on either direction. That tells me that momentum has kicked in, and I am staring at as hawk to catch the wick of the next 15-minute candle in anticipation that the trend will continue in the direction going bullish. So what I do, I put a red box around this. It's very simple. It's just this square box, and I just highlight the candle, and then I put in the next candle that I want to trade in and stop at the start of the third candle. So this is this box right here. And what is it that I'm looking at? This is getting a little confusing. So tell you what, let me delete this one, and then I will share those trades as well with you. Let me delete this, let me delete this. Okay, just let's look at this. All right, at this point in time, I am just focusing on this large bullish candle and nothing else. This is my focus area. So I clearly see that the price dipped lower, and then it had a huge momentum push upwards. So there was obviously some level of supply. Typically, pushes like this, straight push with zero inducement, are zones that get broken or be used as liquidity themselves, because there is definitely liquidity below this. So you'll see if there was no pullback and higher, and I will talk about this in a bit, that price typically will use this zone itself as liquidity before it then moves up. So I'm fairly aware of this at the back of my hand, but I'm looking and thinking bullish because this is the trend, larger internal trend that is happening. I'm waiting for the pullback, which is the wick of the previous candle creating the wick of the current candle, and I'm trying to cast that wick moving and anticipating that the trend is going to go higher. So as price is developing, what I noticed was that it had a nice dip. It did not touch my zone, so I'm not looking for trades. But once it dipped in, it started breaking to the upside. And once it starts breaking to the upside, you can see that it's already breaking internal of the internal structures, right? So the high of this wick is gone and it's putting in trends, which means that this has now become liquidity or inducement. So that would be my liquidity taken. So, excuse me, let's mark it. So that would be my 1 minute liquidity taken. Check one aspect of my mechanical entry model. It went into a zone, perfect, check two, and it gave me a good reaction. Now, I would have liked a healthier reaction than this, a longer candle maybe. It only broke this little buy to sell zone over here. So it broke this fractal high of this last bearish candle, went higher. I would have liked this candle to be a little bit more on the bullish side, which has a little bit more momentum, and break this high as well. So what do? And I'm not going to miss this because the candle is great. We are at London Open. I'm expecting or anticipating the momentum to continue. The inducement is there. It is reacted from the zone. I know the risk, and I'm going to put a buy stop entry at the close of this candle, right at the wick. Why? Because if this wick goes, then I'm anticipating that the next candle will at least break the high of this. And once the high of this has definitely gone, then that is my entry model anyway. So I want to be involved in this trade. What happened? I'd get involved. The trade flew to 3R. So we will capture this, and there was no coming back for a break even or anything. So let me do this. Let me capture this as 2R/3R, right? So you get, depending on your targets, you can set it up as 2R, 3R, and we will continue using both. I use 2R. I would have stopped over here, but this trade had the potential to go much higher. Okay, so that was the first, second, third trade of the day. Mechanical entries, a lot of logic behind this. If you understand fractal structure, then you cannot go wrong with this. It shows you the direction that the market wants to move. Obviously, not all trades will be winners, but it'll give you enough edge where you are very healthy, profitable in your accounts. Okay, so that was one trade. What happens next? And excuse me, what I'm going to do is I'm going to delete this and I'm going to delete this so you all don't get confused. And I'm going to bring my red box over here and I'm going to use exactly the same thing like that. Now what have I done? I'm looking at this candle. Why? Because it broke all the structure to the left, right? Look at this. Trend is clearly on the bullish side. It had a pullback and now it's going bullish, right? So the trend is clearly on the bullish side. It had a pullback, right? Which is this pullback. And now I want to take or be part of the trade when I catch the wick over here, and then be involved in this trade pushing upwards. I'm not sure if this wick is going to go up, right? I'm not sure if this candle is going to go up. I'm not sure if this candle is going to go up. I'm going to keep looking at entries as the candles keep progressing and giving me signals. I'm going to keep getting involved. Hopefully, as it decides to change direction on me, I'm already at break even rather than a -1. Okay, so at this point in time, I'm just focused on this box here. Let's see what happens. Okay, so price is definitely moving up. It came down, it came up, it came down, right? And then I'm looking at the next candle starting at 11:30 because this is the 11 o'clock or 11:15 candle. I'm looking at the 11:30 candle and the start of the next candle starts from here, okay? So what do I see? I clearly see, and this is my second model, mechanical model that I look at. I clearly see there is definitely some level of supply here, right? You cannot deny the fact. It has taken liquidity, so this supply has broken some level of internal structure, which is this low. So definitely there will be orders there, and then I'm waiting to see what type of reaction happens from this, right? So as price is moving up, there is definitely a reaction that is coming up over here, and then there are a couple of methods that you can enter. I'm looking for a strong reaction candle. I'm looking for this supply zone to go, because if the supply was strong or there were enough orders in it to change the direction of the market, then this supply should have created a lower low. In that case, my entire bias would have been wrong and I would have not been involved. But in this case, what happened was that the previous candle is bullish. I'm anticipating the next candle to be bullish to continue the 1 minute trend, which it clearly shows me on my chart. I'm looking for this supply to fail. And once this supply fails, then I am more on the positive side that the trend will continue rather than that the trend will immediately change on me. What more it tells me is that I have a liquidity piece taken right here, right? I've taken this liquidity. The reaction has gone up. I am definitely in the upside. When I say liquidity here, what I mean by is that this strong lower high, which put in a lower low, is now broken. So it wasn't a sweep, right? It closed above this. It is now broken, and the market is now flipped bullish again. So how will I enter this trade? I will simply pick this, and I could enter at the open of this candle right here. I could have opened at this candle right here. I could have entered at the anticipation of this and kept it like this, right? So at this point in time, I don't know the reaction would be like this. But what I do know is that if price is reacting from this supply, right, this is the high of the candle that should not be broken, right? Because this high should create a new lower low. But if this gets broken, that means that there are not enough orders in the supply, right? And most likely, if this gets broken, the price is going to run the entire supply zone. Now, often it happens that the price will come a little higher, sweep this, and then continue going downwards. This is a risk that you have to take, but I've seen many examples where a failed reaction is something that I would take and typically would provide you a good enough edge to be in the market for a good run. So let's assume that we are 2.85. It did not reach 3, but we entered over here. It was a 2.85, and if we had entered over here, it would have been a 1. If we had, those were the only 2 entries that here. Or if we had taken this, we would have been sitting at a 1.67. My bread butter entry would have been over here because I'm anticipating that this high will break. Once it breaks, the supply is taken out just as it did. It came back. It did not reach the 1 hour for me to go even. It went to 0.93 hour. If it had gone 1 hour, I would have broken even for sure. But it did not, and then it went to 2.85 hour. And let's put in our trade right here. So it went to 2 hour, and you would have been a break even because there was no 3. Yeah. Okay. Let's move on. So that was the trade that you saw over there. What happens next? The next candle gave me a strong bullish close, right? And I'm very excited about this candle because what that tells me is maybe the direction is changing, the trend is strong, the candle is long enough where it's establishing a solid trend, and it is closing below the low of the previous candle. So that means the structure has changed now, right? So then what I do is very simple thing. I mark the spread box on that candle in anticipation that the next candle will continue the trend downwards, and we look and wait to see what happens. So this is the box that I drew, and clearly higher, higher, high, low, higher, high, high, low, higher, high, high, low, higher, high, and then all these lows get broken. So the downward trend has started. And in fact, if you were to look at this over here, it got broken afterwards, not previously, but I would use this low as my last low that created this high. This to me is too fractal, but I'll keep this one because it has nice, good separation, right? So the price is trending downwards. This would be my little supply zone. I'm waiting for some level of liquidity or inducement taken. It was taken, so this high was responsible for breaking this low. Once it broke this low, this becomes the strong high. Once it gets swept, once it's mitigated my supply zone and I have a reaction, I'm getting involved. In this case, what happened was I put in a sell stop entry, and instead of closing it right there, which would have been a 2.2 pip stop loss, a little bit too tight for my comfort, I included this candle. I could have included the entire zone. That would have been a bit too much, but these type of trades also work out. If I had put it on the entire zone, I would have been a break even, but I put it like such, and that was a 2.03R. And let's call this one a winner as well before it breaks even. So I'll take my little text tool, come in here, Joar, and the other one was a break even. Fantastic. Okay. So when I put the candle, the same thing I continue, right? I would have done exactly the same thing on the next bearish candle. I would have put in a box around here, but in this case, imagine that there's a box around here, but the box never gave me an entry and it broke the high of the previous candle. So you see the wick over here going higher than the wick of the previous candle. This is a liquidity grab and there was a reaction. So I trade each candle by itself. Right? If I were looking at this from a larger structural perspective, I could clearly see that this was a downtrend. There was clear liquidity. This high broke this low and obviously created a lower low. Once it was swept, meaning liquidity was taken and it came down instead of closing above, and then there was a nice reaction candle which broke all of these lows over here. I could have put a sell stop entry over here with the high being here or here, and that would have been a nice trade. But I did not do this because I don't trade larger structure. I'm looking at each 1 minute candle trying to cast a wick in the direction of the previous candle. Okay, so I leave this one here. The same thing happened with this. If I were to put a box around this, I did not get a good entry. I looked at this bullish candle, anticipating that the next bearish candle that happened would go bullish, but there was no entries and we were coming close to the end of the sessions anyways. So when I was coming at the end of the session, this is everything that I've marked up, again, to reinforce the entire strategy, the mechanical entry models in my mind, that it works. It builds a lot of confidence when you're marking live charts and you're taking not real trades, but you're taking trades as if they were real to see your understanding of fractal structure of the markets. So once this bearish candle happened, it was a beautiful candle because it swept the high and then it closed and it went all the way down, breaking these lows. So it put in a lower low and then it closed bearish. I would have liked if it had closed below these wicks of the previous candle, but yeah, it's closed bearish. It's a strong bearish candle. Why not? Let's assume. Let's see if it gives us any entry model. So this is the red box that I put around that candle. I'm waiting for mechanical entries, right? So what is it that happens? The trend is downwards. It broke the last lower low, which had put in this high. So this was strong low. It got broken over here. Price moved upwards. Now, obviously, when price is moving upwards, I'm anticipating that there will be some orders here, or when price comes back into the zone, there will be some level of reaction. So price went up straight. It came down. It did not mitigate my zone, so I did not place a stop order directly over here because there is no liquidity taken. This could be a simple up, down, and sometimes these trades work out, sometimes they don't, but there is no edge that I found in these type of setups. For me, either it has to be a win between supply and demand zone, one has to fail with clear reactions from both zones within that red box that I see, or some level of liquidity or inducement is taken. The zone is mitigated. If you're looking for a bullish trend, then the demand has to be mitigated. If you're looking for a bearish trend, then the supply has to be mitigated, and then I'm getting some sort of a strong reaction from that zone, and then I enter, right? So there's no liquidity taken. There's no battle between supply and demand at this point in time, so I'm sitting put. I did not enter. So there was a reaction, and then price sort of stalled, and then there was a strong reaction over here. At this point in time, the reason I entered in this trade was because if price goes down and then it goes up, I am not anticipating for this high to be taken out. If this high gets taken out, then the entire bias is wrong. So I placed my stop loss in a safe area where if this goes, then the entire trade idea is gone. And then I saw a nice bearish strong reaction candle that closed below this. So if you want to call this as mitigation, or if you want to look at it like this, then obviously this was a failed reaction, meaning that this demand should have placed a higher high. It did not happen. It closed placed a stop order entry over here, and I got involved. When I got involved, what happened? I usually it hit 1 hour break even, and then it went break even. If you did not put a break even, then this would have been a pretty healthy trade all the way down to this low. So what are we looking at here? Let me just see. About an 8-9 hour trade right there then. But obviously I wouldn't recommend, and nor should you hold your trades for that long unless you are 100% positive in your market direction reading and your analysis. So for me, this was a break even, and let's call it that. Push this over here, text, break even trade. Yeah. Again, this is the lull, guys. So I'm not really taking any live trades at this point in time. Okay, so what happens next? Not much going on here. This bullish candle did not break any structure, so it could be just a drop, a pause in the market, and then a drop again. But when this candle printed, so I was quite interested and excitedly looking at this. I put a box around this, obviously, and let's look at what it gave us. So this is the box, right? Definitely a downward trend, but there was absolutely no entry model. According to my rules, there's no mechanical entry model. So there was no liquidity taken. You can consider this high or equals that this was a sweep of liquidity. Yes, you can consider that this high, let's put it like this, I can call it, you can anticipate or argue with me that this high broke these zones, the lower lows, and then it got taken out, and it got taken out pretty nicely where it was a genuine sweep and the price did close bearish. Yes, I will give you that. If you want to be really, really aggressive, you could have placed your short right here or at the start of the next candle. Let's say if it broke this high and place it over high. This would have given you a nice, almost a 3 hour trade, depending on your stop loss placement or your entry. If you had placed it like this, would have been a 3.65 hour trade. But in my books, this wick did not react into any supply zone that I would deem supply. It is in the middle of the candle. There is no pullback and then push down, which would be an order block or which will create a clear zone for me. This is just one giant down push, right? Now within this candle, if I were to go into seconds chart, 15 seconds, 5 seconds chart, I'm sure there would have been some level of supply hidden within this candle here. But on the time frame that I'm trading at, there's nothing. So I'm not interested in this trade because my mechanical entry model did not play out. So we will leave this as is. We will not mark anything on it. Okay, so moving forward, this little doji star indecision candle, I'm not interested. Obviously, the next candle is bullish. It broke multiple structure. It broke the structure here, brought the structure here. So I put in a red box, exactly so. And this is one of the trades where there was no liquidity taken, but now I'm looking for a battle between supply and demand to get myself into an entry, right? Because this is a nice candle that I like. The wick is higher on this one. So in the previous ones, like this one here, a nice bullish candle, but the body of the candle is larger, covers more area of the candle than the wicks. In this case, the close is almost 50% of the entire candle width, right? So it's not that the body is more than at least 3/4 of the candle entire range. So what happened? There's definitely bullish pressure coming in. We are breaking the lower highs and we are creating new higher highs. So when price is already printing and it's coming back, the first thing I do is mark the supply zone. And then I'm waiting to see where it's reacting from. So the first thing I notice is that there was a wick over here and then the price pushed upwards. So let me say, where did it come to? I look on the left. Clearly there is a demand zone over here. This actually swept the previous low and then had a nice push. Definitely orders here. Now, why is there no liquidity here? If price had gone up and then come back and swept this, I would have said definitely liquidity is taken. But this low, the close wick, the wick low, not the close of the candle, the wick, what did it achieve? This low did not break any high to the upside, right? It created a bunch of inside bars and then the low itself got broken, right? So there is no liquidity taken. At this point in time, I'm not interested unless there is a battle between supply and demand. And I'm anticipating that demand would win because the trend is to the upward, and I want the trend to continue. So price reacted, went up, and then since I drew this zone already, I'm anticipating a reaction from this zone, and initially it gave me a reaction on this wick. The next candle opened up, went down, and then closed bullish, right? So when I see where is it reacting from, clearly there is another demand chain building up. So there's this demand that's building up. And then I'm thinking to myself that this high should break. If this high does not break and it creates a lower low, then the entire bias or direction of my entry model is invalidated, and I'm not interested. But if this high breaks, then you have taken out this entire supply. Once you've taken out this entire supply, I'm anticipating the direction to continue. So I put a buy stop entry over here, a low at the start of the reaction. I could have put a low over here to cover the entire zone, but that's 5.5 pips. In this case, I thought it was pretty high because the price action is very clean, and I kept it like this, 3.6, and it gave me a 1.4 R, which would definitely be a break even in my books. So let's put that in. Break even. Okay, let's move forwards. And mind you guys, we are looking at what? The lull period. Okay, so as price is now moving in, and you get the idea, as price is moving in, this is another one. So this is a trade, a beautiful trade, and it's a good one. So as New York is opening, you have the previous candle close bearish, right? So I'm looking at this, and I'm looking at the previous candle was bearish, this candle was bearish, this is the candle that I'm interested in trading. How do I cast the wick? So I put my box around this. So this is the small box because the range of that candle is fairly small. And I'm just looking at anticipating that there would be some mechanical entry model that I would get. Obviously the price is bearish heavily, right? And this is a pullback. And now I'm anticipating the price to continue. This is something that I would not take. I was just marking it on my charts because it was not very clean. And unless I've not seen it hundreds of times before, it is very, very clean. I know what I'm getting involved. I'm not interested. I saw a lot of inside bars coming in many times that this demand was tapped in without creating a higher high. So that is one confluence that this demand would fail, right? And then when it started coming in, went high, it came back again on this candle. I'm anticipating what happens next. Maybe there would be a battle between this zone, right? This new zone that came in. It started reacting, but it never touched the zone, and then it closed pretty bearish. Like, look at the previous candle and look at the body of this candle. So there was, you could argue, a momentum candle that came in, and I'm thinking that it's so close to the fail zone. If I put a sell stop entry over here and just covered my high, let's see what happens. And bang, it was an awesome trade that I could have taken, and this would have ended up all the way down to what? About 10R, almost 9R right there. But something that I would not do because it does not meet my rules. So this is a trade that I would not even mark. I wouldn't even call it a break even. What happens next? But this is a good trade to understand what is going on. We had a bunch of bearish candles. Again, I was marking my thing, no entry model set up until this bullish candle came in. And the bullish candle, what it did was it created a new higher high. It broke the high of the previous candle here with the wick. It created a higher high, and it closed relatively strong bullish. So I'm anticipating that this momentum should at least continue for some time before it changes direction, because overall the trend is heavily bearish, right? So let's look at what happened here. So this is where price was accumulating. It was in a range. It was waiting for change of directions, and I could already see the first signs, because this high failed to create a lower low, which is right here, because this low created the higher high. It broke the previous high. So this is definitely strong, but if this is strong, it should have created a lower low, but instead it got broken by itself within the box. So that means that the trend has changed, right? So that's one confluence in my books. Next, what am I waiting for? I'm waiting for either liquidity sweep and a reaction from a very solid supply or demand zone. In this case, price started to come back, pull back into a nice level of demand. This demand also is a sweep zone, so builds another confidence that this will hold. And this high then did not give me any level or any confidence that a reaction candle was strong. It created many very corrective highs, and I'm not interested. So when price is going in the direction that you want it to go, it goes in impulse, and this was very corrective for me. So what do? I get involved in this candle, get involved in this candle, get involved in this candle. They're all just small bodied candles, very corrective price action. And even though this low now has broken this and this and this, so it has definitely broken internal structure to the upside, but then it got swept pretty aggressively. And now I'm interested. What am I interested in? To see if there is a reaction candle. Next candle is a bearish candle, and the next bullish candle does not really break any sort of structure, internal micro trend structure on the side. So this high stays. What I did was I said, if the high of this previous candle goes, that means that was a strong reaction, and then it goes, right? I could have done also put in a supply zone here and waited for the reaction, and then I could have placed my entry long at the fail of this. So the price came in, it obviously reacted, and it reacted to a demand zone in here, and I could have done this. I could have gone and taken one of these lows, given me some buffer, but that all would have been pretty arbitrary. Like, where do I put, where is the strong low? There is none at this point in time, right? So for me, my first opportunity that I got was that I looked at this candle here. I saw good level of liquidity taken. I would have liked it to be swept, which is why I placed my stop order entry at the high or at the close of this candle. And as soon as it broke, it retraced back, and then it broke again, retraced back, and then once it got me this nice strong candle in, which would have been the end of the candle that I'm going to trade, because it ended up being an inside bar. The next candle opened up, and then it just shot to the moon. This obviously gave me a very easy 2-hour. It was a 3-hour setup with no break evens as well. So let's put in our marker right there. So this gave us what? A 2-hour and a 3-hour. And there you have it, folks. And there was not much exciting after that. Okay, so let's tally up all our trades and see where do we end up. We had a break even, we had a -1. So what do we have here? Oh, so this is 2 and a 3. So let's pull this on the side. So let's calculate all the 2 hours, right? So 1, 2, 3, 4, 5, 6, 7, 8 are, and then a -1. The rest are break even. So we had a day with 7 hour, right? And then if you took 3-hour trades and break even, so we had 1, 2, 3, 4, 5, 6, and a -1. We had a 5-hour day there. And there you have it, folks. I mean, it was simple, it was repeatable. If you took every one of these trades, you ended up with a very, very healthy, and sometimes it's your month's target to reach a 7-hour or a 5-hour. But we did that within one trading day, right? And that too within one couple of hours in the London and couple of hours in New York. The trades that happened in the lull periods were all break even, and the trades that happened at pre-London, so Frankfurt, there was a break even and a -1, right? So all the trades that gave us those returns, those healthy returns, were during London Open and New York Open. Very simple. Very good on your mental state, your mental health, repeatable, consistent. You are not getting paralyzed by analyzing multiple time frames, the daily, the 4-hour, the 1 hour, and whatnot. You look at each candle, look at what it's done fractally. Has it broken any structure fractally? And then you go into 1 minute time frame to confirm that fractal structure, and you wait for your mechanical entry models. And your mechanical entry model is what? You sweep liquidity, you take out inducement, you wait for a zone to be mitigated, you wait for a reaction from that zone, and put a buy stop and a sell stop with your stop loss behind the high of that previous candle. And that's it, guys. If you liked the content, or if you liked what I shared with you guys here, please do like and subscribe, and then I will catch you very soon in another video coming up. Take care, guys.